Well, junior explorers and developers have rushed over the last 12 months to secure a spot at the table for the ongoing gold rush. The world's largest gold miner had a different plan. They wanted to divest assets, and not just piddly little operations either. No, they wanted to get rid of about 1.2 million ounces a year of annual production. Enough production that on a combined basis would basically equate to a major gold producer's worth of annual production. Why? Let's dive in. We are, of course, talking about Newmont's now completed but not technically completed non-core asset divestiture plan. Basically, the goal of the program was to make the world's largest gold miner have the world's best gold assets, which of course follows Newmont acquiring Newcrest, one of its largest competitors, in the fall of 2023, which brought a number of top quality assets to the portfolio. That transaction brought together a total of 10 Tier 1 assets. And as part of the transaction, Newmont's executives basically promised to shareholders that they would get rid of any asset in the portfolio that was not of the absolute highest quality, a standard which applied to the entire pipeline, from exploration stage to development stage to operating stage projects. If it didn't meet the criteria, it had to go. The secondary benefit here is that the monetization process was also expected to add $2 billion to the balance sheet, which would help pay down some debt at the same time. The official divestiture plan was announced last February. At the outset, Newmont intended to divest of 6 operating assets that didn't meet this criteria, alongside 2 development projects that were also earmarked to be sold off. With that plan now deemed to be complete by Newmont, let's see how the strategy fared. But first, for those that don't know what a Tier 1 asset is, here's a bit of an explainer. In mining terms, a Tier 1 asset basically means a long life asset, think 10 to 20 years at minimum, that is producing a lot of gold on an annual basis. There's a bit of a debate in terms of what sort of production this implies. Some mining consultants say 250,000 ounces of gold a year, while others, such as Barrick, say 500,000 ounces of gold a year. And then some operators, such as Newmont, have a bit more of a complex requirement. As per Q4 2024 investor presentation, Newmont defines a Tier 1 asset as having a number of qualities on average over its mine life. First, production of over 500,000 gold equivalent ounces per year on a consolidated basis. Secondly, an average all-in sustaining cost on a per ounce basis that is in the lower half of the industry cost curve. Third, an expected mine life of over 10 years. And fourth, which is the big item that most in the industry ignore, operations in countries that are classified in the A and B rating ranges for Moody's, S&P, and Fitch, which basically excludes a lot of African projects where other majors make their bread and butter. This definition, of course, is subject to a number of risk factors and assumptions, such as geology being correct, the geopolitical stability of a region, certain metals pricing, etc. But you get the gist of it. With that definition in mind, Newmont set off to dispose of 6 operating mines and 2 development projects with the goal of generating $2 billion in cash. Those operations included Telfer, Akium, CC&V, Porcupine, Eleanor, and Musselwhite, which in 2023 and 2024 produced 1.2 million ounces on a combined basis. While the process was launched in February, the first transaction didn't materialize until September. Newmont began its sales process with a bang, managing to sell off its Telfer operation, the small operation on the cut list, as well as a 70% interest in the Havieron gold-copper project to Greatland Gold in a transaction valued at up to $475 million, of which $208 million was to be paid in upfront cash. That transaction closed in December. Next to go was Akium, which last year produced 204,000 ounces of gold in Ghana. The mine was sold to the Chinese Zijin Mining Group for cash consideration of up to $1 billion, of which $900 million was to be paid upon closing. Musselwhite was the next to go, selling in November for total consideration of $850 million to Orla Mining, of which $810 million was to be paid upon closing in the form of cash. A week later, Eleanor sold for $795 million in cash to Dilmar Limited, which was then followed days later by the sale of Cripple Creek and Victor operation for $275 million in cash, of which $100 million was due up front to SSR Mining. Finally, in January, Discovery Silver agreed to pivot its focus and acquire the Porcupine operation for $425 million in total consideration, including $200 million in cash upon closing. Following the sale of Telfer and Havieron closing in December, the sale of Musselwhite, Eleanor, and CC&V closed in early March. Well, the sale of IKM and Porcupine closed this week, leading the company to declare the process complete after generating total proceeds of up to $4.3 billion, which includes $527 million from the sale of other investments. Collectively, upfront consideration is estimated to amount to $3 billion, which assumes that Eleanor saw consideration entirely upfront because specifics were lacking. While deferred consideration amounts to $565 million, Newmont also received equity consideration of $243 million in the form of Greatland and Discovery Silver shares. But is the process really over based on the initial goals set out by Newmont? Not exactly. The development properties here kind of put a wrinkle in that, causing Newmont to qualify their statement in their announcement. Quite plainly, it's not complete. The program initially set out to sell off 6 operating projects and 2 development projects. Yes, the 6 operating projects were sold, but that's only part of the program. Coffee, a gold development project based in Canada's Yukon Territory, has not been sold. The company hasn't even managed to enter into an agreement to sell it. It's just designated as held for sale on the books. Which, well, duh. But if Newmont says the program is complete, then I guess, well, it's complete. Alright, so let's wrap it up. Aside from the technicality, Newmont's divestiture program was a massive success. After initially setting out to generate $2 billion in proceeds, they managed to get more than double that once some of the other assets sold got factored into the equation. Gold being on a tear certainly helped that. The part that we didn't address is that the process basically saw Newmont take a big step out of North America. Of the 6 operating mines sold off, 3 were in Canada, plus 1 more development property that was earmarked for sale that never sold, and 1 was in the US. Bruce, Jack, and Red Chris are the only other remaining wholly owned assets in North America, alongside the Nevada Gold Mines JV with Barrick in Nevada, which really isn't a great look for North America when the world's largest gold miner basically walks away from you. But I digress. Alright everybody, thanks for watching. If you enjoyed this video, please smash that like button, subscribe, and ring that notification bell. Guys, if there's stories you want us to cover, please let us know in the comments section. Thanks for watching, everyone.